All right, we are live. Thank you everyone for joining us in today's video, and welcome Jim Black, the man, the myth, the legend.
How you guys doing? Good to see everybody, and thanks for having me on, Jason, for another fun topic today. So
absolutely, this is a hot topic. We were talking yesterday about what should we do our video on, and I actually was thinking, gosh, maybe we should do a video about how to assume a mortgage, because we just had a client who is a YouTube subscriber. If you're watching today's video, I won't mention his name, but he found me through YouTube and wants to buy a house in the greater Sacramento area where I serve my clients. And he was interested in that house because it had a 3.4% 30-year fixed rate that was assumable by the new home buyer. And so we did a lot of digging regarding, how's that work, the pros and cons, et cetera. And so I thought it would be a really good video to make, because we have, near record low housing affordability on a national level due to the increase in prices and of course rates as well. And so if you can get a, less than a 4% rate right now, when average rates are around, 7+%, it makes it really attractive to buy a house because you can take on these rates that we may not see for a very long time. So that's why I want to make today's video for you guys. So just got the housekeeping first. So this is a live stream. We're posting this at 3:30 p.m. on Tuesday. Jim Black and I do this every single week. And also, if you want to see our previous live streams, you can go to my YouTube channel and click on lives, and you can see our past live streams. We do this on a weekly basis. So there's that. So we're going to talk about this example for this person who wanted to buy a house that was assumable mortgage, the pros and cons, and then also we'll share with you guys how do you actually find houses that are for sale in which you can potentially assume their rate, which potentially could be a lot lower than today's rates. So there's that. And on top of that, if you guys have any questions, we'll do our best to answer every single question. We'll do this for 1 hour until 4:30 p.m. Pacific Standard Time. But if you want to see your question get bumped up, send us a super chat, and we'll get to you first. Kind of challenging to answer everyone's questions, but hey, Steve-O, thank you so much for joining us. Steve, a longtime subscriber, appreciate you. Christina is here. Christina has like 250 million subscribers. I'm just kidding. 250,000 subscribers. Appreciate you joining, Christina. Awesome. Pretty strong echo, my friends.
Is that better? Is it? I can't tell what's going on.
Man, we tried to fix that problem last time. We definitely had an echo. Jeff, do you still
I can't hear an echo on my side. Jeff, can you give us a heads up again? Not the super chat. Okay. I don't know.
Not the super chat, Jason. I know. Yeah, I don't hear an echo this time. So if anyone else hears an echo, please let us know. Jeff is saying there's an echo here, but I don't hear it, and we're trying to figure that out. I think last time we might have a.
Oh, here we got it. Yes, it's better. Sweet, right on.
Yes,
yeah. Jeff. Thank you.
Amazing, awesome, right. Cool. All right. What does it say? So Winnie the Pooh. I bought at 2.875% 30-year fixed. My loan was assumable if I ever went that route. So yeah, let's talk about this. Yeah, no echo. Seems fine to me. Perfect. Thank you guys. Appreciate you. So we'll get to you guys' questions. If you guys have any questions, I'll just do exactly what Christina Smallharm has on her channel. Just put question in caps, and then we'll get to your question here in a little bit. But maybe we can kind of talk about this scenario in which my client reached out to me who was interested in this house that was a 3.4% 30-year fix. And speaking of a super chat, thank you, Christina. Appreciate you. Just want to say hi and thank you. Appreciate you, Christina. Thank you so much for the super chat. So let's just talk about this scenario in which this person wanted to buy a house. I reached out to the agent, found out that the current rate that the homeowner had was at 3.4%. That was for a 30-year fixed rate mortgage. And by the way, anyone who's watching today's video, I appreciate you, Christina, for this super chat. Check out her YouTube channel. So anyways, when looking at this, Jim, you can kind of touch on this as well, because in order to find an assumable mortgage, it's kind of hard to find, and I'll talk about that in a little bit. But this scenario, the asking price of this house was $500,000. The current loan balance that the homeowner owed on their mortgage was, what was it? $430,000.
Yeah, 430. Yep.
430. So in order to assume that mortgage, a new home buyer, and this is what, by the way, was a 30-year fixed FHA loan. If you're using an FHA loan to buy a house, the minimum down payment is 3.5%. In this scenario, if you want to assume their loan, you would have to put down $70,000 in cash. That is the difference between the asking price, $500,000, and the current loan balance that the current homeowner owes on their loan at $430,000. The difference there, $70,000. So if this person wants to buy this house with an FHA loan, taking on their loan, rather than putting down 3.5% down, they have to put down $70,000. So that is kind of the big challenge. And any thoughts regarding that? Because I've been talking a little bit here, Jimbo.
This is good. I like this. The big thing we want to think about is anytime you look at taking over someone's loan, it's going to be whatever their current loan balance is remaining relative to the purchase price you're going to be able to buy that property for. If it's an FHA loan or VA loan, for example, you really can't have any secondary financing put on that property. What that means is the difference between what you're going to pay for the property and the loan balance has to be basically down payment or cash brought out of pocket. So you always want to look at, again, what's the opportunity cost of putting more money down versus maybe putting less money down and having a higher interest rate. So you always want to evaluate in this situation with assumability, do I get a loan that's going to be big enough to support my down payment? And what is that difference in interest rate today versus what I would be getting on that loan? And what's the most important thing to find out all the options available is you have to go to the servicer first. The servicer of a mortgage is the person on the statement that you call with any questions you have about your loan. You want to start there first to see what options of qualifying someone to take over your loan are, which is also something that could take time. So while you want to do this maybe on your offer to write your offer and put it into to get the offer accepted, you may have to go with a conventional option or current rate option first and hope that you can get an assumable approval, because it is case by case, depending on who has that loan and what their covenants are and what restrictions are to do that.
Yeah, absolutely. And I want to reach out to here, Steve-O, too. Thank you, Steve-O, for the super chat. Appreciate you. Have a beer on me, but the inflation prices, you're all mighty to have shared. Yeah.
Can you explain what super chat is? I'm new to
Yeah,
this.
so Jim's kind of new to this. So super chat is like if someone can send a donation through YouTube, and then it shows up as it's color coded, and it kind of shows up at the top of the list. So if you want to get your question answered, or if you want to show, I don't know, your thanks to the channel, whatever, some people send super chats. But in general, when someone sends a super chat, the person who is making the video tends to, give them a shout out or answer their question before other people.
I love it. I love it. Thank you, Steve-O. Thank you, Christina. Appreciate it.
Appreciate you guys. So yeah, let's talk about what Jim has to say here, because Jim's saying here that the down payment or the amount of money you had to come out of pocket to buy this house, in other words, $70,000, the difference between the loan balance at $430,000 and the asking price at $500,000 at $70,000. But this is an FHA loan. If the person was going to use an FHA loan to buy a $500,000 house, your minimum down payment would only be $17,500 and not $70,000. That's kind of one of the cons regarding this, not program, but this, by assuming a mortgage, you have to pay the difference, not the minimum down payment that the loan servicer would require, or the loan lender would require. So
remember, guys, remember over the life of these loans, the loan balance is going lower. What's also important to understand is that the loan limits every year for the last 20 years have been going higher. So these loans, if the older these loans are, the chances are that they'll have a bigger gap between sales price and current loan balance. So be aware that these these loans really should be targeted, in my opinion, the last 3 to 4 years to potentially get the appreciation of that house less relative to the payoff of the loan balance, if that makes sense.
Yeah, for sure. Because if this house was $500,000 and they purchased it 5 years ago or 10 years ago for $200,000, how many people have what, $300,000 in cash to buy the house? And it's kind of fewer and far between. So in regards to the types of loans that are assumable, in general, conventional loans are not assumable. But in general, FHA loans, VA, and USDA, these are government-backed loans, are assumable mortgages. But reach out to your loan servicer to find out for sure if your loan is assumable. Because I've seen scenarios in which a home seller doesn't even know that they have an assumable rate, and that it becomes a lot more attractive if you want to sell your house because of that low rate you can offer potentially to home buyers.
Absolutely. And there's a couple things you want to look at. If you have a copy of your note, or in Jason's case, we asked to get a copy of the note to make sure that it has whatever assumable clauses in there. A lot of times you're going to see a note either have assumable clauses in there or the opposite effect. There'll be a due upon sale or due upon transfer clause in those notes. So due upon sale means I sell the property, the note is due. Or due upon transfer, if I was to transfer it from one family to the next, or maybe even related parties, I could be triggering that loan to be paid and due. So it's just important to know you need to look at that note if you are a homeowner, or if you're buying a property, we need to get a copy of that note to make sure we know what potentially can be offered. And again, it's up to the servicer to promote the approval of this if the borrower is qualified.
Yeah, that's definitely one of the cons there. So maybe we can talk about the pros and cons, and then we have some other stuff to talk about as well, and we'll answer some questions here as well. So again, if you guys have any questions, put question in caps before your question. So in my opinion, obviously the biggest pro is that you could get a 2.7% or a 3% rate, a rate much lower than current rates today if you were able to buy a house that has an assumable mortgage. The downside, though, of course, is that if you want to take on the current homeowner's loan, you have to get approval from that or their lender. So you can't use your own lender. You have to work with that lender, and that lender actually has to approve it as well. So that's a downside as well. The upside, of course, you can save a lot of money on interest. And of course, one thing too, I noted that in general, unless you know something different here, Jim, there's no appraisal fee that has to be paid by the buyer in general. And on top of that, there's no origination fee as well, unless you know something different, Jim.
Yeah, it's just, yes, it's a different process. It's almost like a service that is paid up front when you get the loan that most people never use, is the way I look at it.
In general, what is the origination fee for when you buy a house? I know it varies greatly, but what's the average? Or
yeah, so an origination fee for FHA is about 1.75% of the loan balance that you get. The VA fee, which I do not agree with at all, is anywhere from 0 if you are a disabled veteran. And again, veterans, thank you for your service. Yep. For anyone on the call or watching, we appreciate you. If you are not disabled or have any eligibility for a discount, it's 3% of the loan balance. And the veteran pays that VA funding fee, which I cannot stand. So hopefully that gets changed in the government sometime soon. Again, it's just, I think, a complete embarrassment when we have to have a veteran pay more money to get a loan and use a benefit that they should be entitled to versus get a regular loan that does not have a mandatory VA funding fee.
Yeah. All right. Makes sense. And I agree with you 100%. So let's kind of talk about the cons too. I think the pros are pretty obvious. You could potentially save a lot of money. The cons is that it can be relatively hard to find. And on top of that, it could be limited in the number of houses that are for sale that do have this assumability clause for their current loan. And I'll share some stats regarding that as well, because I did a search on our local MLS, which is the greater Sacramento area. but also I'll share how to, search for these houses on Zillow, Redfin, and Realtor.com as well. So they're hard to find. They're limited. On top of that, some sellers and agents may not even be aware that the house has an assumable loan as well. And that was exactly what happened 1 year ago when this house that my client was interested in, no one knew that was an assumable rate. What else is there? Yeah, go ahead.
Good. I can share one other thing. VA loans are a little more delicate to the seller of the property. So there's a VA eligibility guarantee where you have a certain amount of loan you can have as a veteran. Well, if this loan gets transferred and is assumed, that still counts against you for further VA loans. So you may be giving up some of your benefit if you're a veteran by exchanging this loan with another buyer down the road with being assumable. So it could affect future purchases. And remember, these assumable loans are really truly mainly for owner-occupied primary residence transactions. So you really have to be in that situation to be moving into these properties, which can be important.
Yeah, and they also could be, these houses also could sell at a premium as well, or could be listed at a premium price as well, because, if the current rate's 7%, but you can offer a home buyer at 3.5%, I could see a lot of these houses being listed for, higher than the current market value. But an appraiser, unless you know something different, would not value the house higher given a lower rate. So there could be some appraisal
Exactly
challenges.
right. They're going to use current average conditions for the marketplace. So average marketplace conditions are average interest rates also. So they're not going to give you more benefit to being able to buy something for what I would say is a discount relative to the current conditions.
Yeah, absolutely. The other downside too is that rather than doing a fast close or a regular close in California, on average, it takes about 25 to 30 days to sell a house. So you get your offer accepted. In general, you can get your keys, 25 to 30 days, whatever your contract states, but that's kind of the normal average. Based on this house that was listed for sale here in Sacramento, I was told that the closing period or the escrow period would be 90 days. It's about three times longer to buy that house compared to an average house in Sacramento as well. And of course, you have to work with the seller's lender. You can't use your own lender because you're taking on the current homeowner's loan as well. One more thing as well is that I believe in general, there could be a lender assumption clause or fee you have to pay in order to assume the homeowner's loan as well.
There can be, and I think that's case by case per lender. And just know that we don't know what that is until you're in the process. It's not going to be substantial, but it's something that does play a role.
Yeah. Okay, cool. I want to share my screen because I want to provide how you guys can actually search for these houses for sale on Zillow, Redfin, etc. Can you see my screen here, Jim?
We got
Zillow?
you. Yep.
Okay, cool. Yeah. So here is a Zillow. I just searched for house for sale in Sacramento County. Of course, you can look at any area. Just click on houses for sale, any price segment or any number of bedrooms and bathrooms you want. I'm looking at houses for sale, townhomes, and condos. And here's where you can add this assumable key term here. So it says keywords at the bottom here. I just typed in assumable, then hit apply. You can see the houses for sale in Sac County that have an assumable keyword in there. One would assume it'd be an assumable mortgage. So there's a few houses for sale. Here's the one my client was interested in that we toured yesterday. And here's some other houses as well. So there's only what? 1, 2, 3, 4.
5. There's 5. It says 5 searches.
5.
5
oh yeah, thank you, Jim. Right there. 5. Only 5 houses in all of Sacramento County, which is around, over 1 million people live in Sacramento County. Only 5 have this assumable term in their listing. When looking at redfin.com, again, I'm searching for Sacramento County. You can look for any county. Just go over here to the right and click on this, all filters. And you can search for, of course, the different types of houses, whatever. And then go to the bottom. I think it's the very, very bottom, if I'm not mistaken. No, it's not. Where is this? Sorry, I was just searching for this earlier today. There it is right here. So right under home features, also type in Assumable and then click on the search. And Redfin is looking at 6 houses that have this clause. Looking at realtor.com, click on more. And then you can add the keyword right here and just go and Assumable, hit enter, and then you can see the houses for sale that also have this as well. For whatever reason, they're including houses that are under contract like this one. But I can search on our local MLS to see houses that have this clause, but you can as well. If you guys want to see houses for sale on Realtor.com, Redfin, etc. But again, looking at all the houses in Sacramento County for sale, there's well over 1,000 houses for sale. Of course, we have over 1 million people living here, but there's only 5 to 6 houses that have this assumable contract or assumable clause in their listing. Let's get to some questions here as well. If you guys have any questions, put question. Let's get the first one here. Johnny Fly, if you're still watching, Johnny, thank you so much for supporting the channel. Johnny Fly, why would people be waiting for lower rates when rates are still historically low? I personally think people should be buying a house right now. A lot of amazing deals right now. Johnny Fly is always trolling the channel. So Johnny, man, he cracks me up. Anyone else have any questions? We also want to talk about the quantitative tightening as well. Let's see if anyone has any questions.
Is there Derek has a question? Yeah, there you go.
Yeah, he didn't do questions in caps, but Derek, we'll give you a pass. Is anyone talking about making conventional loans assumable?
Yeah, they used to be assumable, Derek, and they were mainly assumable for portfolio lenders. That's important to know the difference between a portfolio lender and someone who is selling the loan off. Portfolio lenders can make their own rules. So when the crash of 2008, 9, and 10 happened, companies like Washington Mutual, Wachovia Bank, World Savings, all these banks could make decisions on the fly and modify these loans because they owned them. They own them dollar for dollar on their balance sheet. Well, about 75% of loans in today's world are not portfolio loans, but they're sold off to mortgage-backed pools and securities. So when that happens, you can imagine that these loans have been traded and sold and bought and repackaged together so many different ways and leveraged that there needs to be a conforming approach to how to handle these complex transactions. So that due upon sale clause or due upon transfer is what really kind of ended that process of doing these assumable parts of the loans. So that's an important part there. So unfortunately, if one bank portfolioed every loan, then yes, there probably would be assumable elements. Unfortunately, a lot of loans are sold off, and you probably experienced it if you've owned a home. You close with one lender, and then the loan gets sold to another lender or servicer. That's very common, and that's something to be aware of.
Thank you, Jimmy. Dan W says, I am literally doing a VA assumption right now. I found a townhome with a 2.4% interest rate. That is incredible. 2.4%, super low. Just under market value as well. And that's remarkable. You don't even have to pay, you don't even have to have VA eligibility to assume a VA mortgage.
That's the one exception for this category. And again, the veteran has to wait for part of this eligibility to come back once you've paid off the loan or sold the property again without assuming it again. So be aware that that's a fantastic thing. Dan, and I'd be curious to see what the purchase price was relative to what you're getting the loan amount for. We know that VA loans can go to 100% of the purchase price. So I'd be curious to see how long that home was owned till this point in time to see that delta between your down payment versus the actual loan balance.
Yeah, you have to weigh the difference between doing a 0% down payment for a VA loan versus the amount of money you have to come out of pocket in order to assume a 2.4% interest rate is what you're basically saying, right?
And what's ironic about assumability So assumability to me means I'm going to be here for a foreseeable future of time. I would like to be able to, down the road in the long run, pass on my loan to somebody else. The average veteran moves 4 to 6 years because of their assignment. So it's ironic that more people aren't, using this product and service, because it's most of these loans should have been originated in the past 3 to 4 years, roughly, right? Because they're getting deployed somewhere, they're moving their families there, and then they're being redeployed 4 to 5 years later. So that should be a category we see a lot of these opportunities. And unfortunately, a lot of times there's misinformation out there, from the homeowner not realizing this, to the agent not understanding what they're dealing with, to the lender not even trying to communicate, because the lender doesn't have a lot of motivation to try to do this, right? If rates are 7% today and you're going to get an assumable rate at 2.4%, they're still upside down on their hedge, so to speak. So that's the interesting part about this.
For sure. All right, Tony, I'm a veteran, had my VA loan assumed. I regret it now, but at the time it was the only way to sell my home and not come out of pocket. This was August of 2022. I needed to move for work. And he follows up by saying, I had purchased it in June of 2021 and had 2.75% rate, but with just over a year in the home, I had no equity and prices were dropping in the Central Valley. I'm sorry to hear that. But you kind of did what you had to do, because I would assume that you were able to sell your house for a premium, given your very low rate as well.
Absolutely. That would have been at that time, if you August 2022, yeah, that rates had already skyrocketed up above 6% at that time. So hopefully that difference in buying power, right? If you're at, what was the rate, 2.5, Jason, 2 3/4?
2.75, he said.
Yeah. So if you're at 6% on average, minus 2 3/4, that's 3.25% difference for a buyer. And we know that every 1% difference in interest rate is 11% roughly difference in buying power. So that buyer who got it basically got an increase in buying power of about 37%.
Yeah.
So they were able to pay a premium of 37% over the price of a normal home at 6% at that time. Pretty crazy.
Yeah, it's pretty wild. Yeah, well said. Winnie the Pooh says between April, I guess that's 21st, April 2021. I don't know. And April 24.
No, it's 1970.
1971. Sorry.
I
Yeah.
think it's 1971.
There you go. 1971 and 2024 average rates were over 7%. So we're at the average. The only difference is the increase in prices, though. When looking at your payment compared to your income, we are historically low levels. Affordability at multi-decade lows. So looking at rates, and for example, in what was this, early 1980s, when the average rate was over 15%, now we're at 7%, so half that, or more, less than half that. But when you count for the fact that home prices, home insurance, property taxes have increased so much, then the comparison to 1971 is a little bit like comparing apples and oranges, in my opinion. Question from Maverick, maybe a Top Gun. Yeah, who knows? Question: how important are cash flow and wedge when buying a house? I'll talk about this. So when buying a house, I would say, do not buy a house unless you plan to have long-term time horizons in which you don't plan to sell it for at least 7 to 10 plus years. That is conservative, because in general, during that time frame, in the long run, home values tend to increase. On top of that, have a stable job, have an emergency fund, etc. So if you want to get ultra conservative regarding that, whether you should buy or sell a house, if you were looking for a house in which, let's just say that you buy a house, the home value decreases, so you owe more than your home payment or your loan is. And in that case, you may not be able to sell your house. But if you have a house in which you can cash flow, in other words, you can move out and rent it, and you receive is at least what your payment is, that's great as well. But in general, when I'm looking at that scenario in the greater Sacramento area, due to the rise in rates, it's virtually impossible to find something in which you're going to be able to buy something, putting 20% or less down, and being able to move out, rent your house for at least your payment. I've seen scenarios in which looking at houses at $500,000, for example, putting only 20% down, you're likely would be losing about $1,000 per month. Let's just say hundreds of dollars per month if you want to move out and rent out your property because of rates increasing so much. So in that scenario, the cash flow would be negative. And if someone wants to buy a house and have that opportunity to have some cash flow, looking at today's numbers, it's virtually non-existent unless you put down a lot of money to buy a house. Anything you want to add regarding that, Jim?
Nope. That's right
Yeah.
on.
Yeah. So wedge, I would say the wedge would be like buying something that you can put sweat equity into. I don't know about you, Jim. I don't think you're not very handy either, right?
What? I'm
Are
really
you?
handy. What are you talking
Okay,
about?
okay. That's true. You can change a doorknob
Wow.
just like me. So
I put 2 curtains up last night. I drilled holes. Yeah. We got,
oh wow, okay.
yeah.
Well, I
My
can
hand,
I can I can put up
I have
pictures on the
calluses on my
wall.
hands. I mean, I work, yeah.
We have painted a house of yours before inside.
Did we? What was that one? I forget.
That was in Tahoe a long, long time ago.
Oh, that's right.
Long, long time ago. Yeah,
Oh,
long time
boy.
ago. Anyways, if you're if you're a contractor, you can buy a house that's a fixer, you can fix it up yourself. I mean, that's an awesome wedge opportunity. And the houses I've purchased have been, cosmetic fixers in which we've updated, and we got some equity out there. So there's a wedge there. But yeah, I would say that it's expensive to remodel, though. I'll see that as well. All right, Crystal, thank you for joining us. Hello, lovely humans. Good to see you too, Crystal. Thank you. Appreciate you. Let's see if there's any other questions here. Are there any stats? This is from Lester. Thank you for your question. Are there any stats on how many loan assumptions occur? I'm not familiar with that. Jim, are you?
I would just say that there's one stat from February of this year from realtor.com says that about 0.4% of US for sale listings advertise an assumable loan. I don't know how many actually closed, but that's the stat. 0.4% are advertised that way. Who knows if they're advertised correctly or not, but that's what the stat is from realtor.com.
Yeah, so man, I would say I think that there must be a lot of people who have a loan who have no idea that they have this like semi gold mine if they want to sell their house. Because again, if you have an FHA loan, USDA or VA loan, chances are, contact your loan servicer, look at your note, that you can have an assumable clause on there. And that could be a great scenario if you want to buy a house, or sorry, if you want to sell a house. So yeah, I would imagine there's a lot of people aren't even aware of that as well. All right, so let's see if there are any questions here. From Joey. These are great tools. Do you know of second mortgage lenders for piggyback mortgages on assumable loan situations? Jim, any insights on that?
So unfortunately, VA and FHA and USDA have very, very few limited options for any type of second piggyback loans. They would be local jurisdiction loans that are charity-based companies. And for example, in California, there's probably close to 500 different down payment assistance options that are available that are specific to city, state, county, type of job, type of industry. But I don't know of any rule of ones that stand out to me that are good resources there. So unfortunately, I also think a lender wanting to give your loan to somebody else probably is not super excited to have another lender come in behind them. So chances are very good that's not likely.
Yeah, I hear you. All right, I don't see any other questions here. We also talked about, Jim, about the quantitative tightening, the decrease in the Treasury buying mortgage-backed securities. So, of course, anyone had any other questions, please let us know and just put question before that. But you want to talk about that, Jim, and how that's impacting?
I would love to. So
let me just preface this too by saying that, just like what last week, we're at nearly a 5-month high regarding average rates, and now today we're at a 1-month low.
Can you
So
do me a
quite the
favor and bring up a
volatile market.
Treasury, a
What's
10-year,
that? Sorry again?
3-month chart would be great, and I can explain what's happened and why.
I didn't hear you, Jim. What did you say?
So like anything 10-year, 3-month average. So I was fortunate to study econ at Cal Poly, San Luis Obispo. I had to pick a major when I was 16 years old or 17, and somehow I picked the right one. And then I studied grad school. I went to and got my master's in economics and finance. So I like this stuff a lot. This is what I'm trained in. The big thing, the theme that happened about 4 to 5 years ago was the Federal Reserve announced that they were going to do what they call quantitative tightening. They were reversing their policy from quantitative easing to quantitative tightening. A simple way of stating what that quantitative tightening means is they were going to be buying less bonds or mortgages from banks and lenders and credit unions and whoever. Instead, they were going to be starting to sell off their bonds, sell off their mortgages to the private sector or open market. Well, that had a very bad impact when inflation kicked in, because when inflation kicked in, the government was no longer buying these mortgages to keep the rates artificially low. They were compounding the problem by throwing more bonds in the marketplace, which meant more supply of bonds, and that normally means lower prices, but instead it's the opposite. If I'm an investor with $1 to invest, and there's a lot of bonds out there to buy, I'm going to pick the one that has the higher interest rate. So instead of me as a buyer negotiating for the best price, the bondholders were negotiating by having to creep up the interest rate that they were going to give as a return to sell their bond. So during this crazy hyperinflationary period, we saw things dramatically increase and spike up. Can you show those charts?
I'm sorry, I missed what you wanted to see.
Yeah, sorry, bud. I don't see anything.
Jim, what do you want? What charts do you want to
10-year, the 10-year, sorry, the 10-year chart, please. And
Okay.
let's look at a 3-year to start with, and then we can look at a 3-month.
Yeah, no worries. Sorry, I didn't
So
hear you.
again, quantitative tightening.
Travis, thanks for joining us, buddy.
Nice.
Jim,
like
I
that.
say Jim Black for governor.
No, I'm good. I'll be the I'll be the little guy.
Thanks,
Again, quantitative tightening has not in a normalized market where there's not crazy indicators of things moving around, a lot of volatility. It's fine. Unfortunately, investors did not like the fact that there was a flood of these bonds in the marketplace and a lot of risk that was unknown, right? We came out of COVID, pandemic, a lot of unknowns. We don't know if things were going to be the same ever again. So in this 3-year, or let's go to 5 years, fine, sorry. If we look at a 5-year cycle here, and we're looking from 2022 and say April or June, we saw a major spike up, a little, there you go, like that time frame. That's where things got crazy, right? That's COVID right there. So that's the date.
1.7%. Now we're at 4.5%, basically. It's wild.
So we saw, and again, right, people were not getting excited. I remember there were stories of big oil tankers sitting for sale, the gas inside of them sitting for sale because people didn't know who was going to be traveling or buying these things. It was crazy. So what I think you're seeing by this example is the quantitative tightening made it a lot worse. The government was throwing money in there, right? Throwing extra money at people, PPP, all the extra stuff. It increased the inflationary pressures, and we saw things skyrocket. So again, things moved rather tightly.
Doubled in like what, 2 months? It's so crazy.
Look how high that angle was, right? It was like straight up again because there weren't a lot of buyers. People were timid; they didn't know what was going to happen. So again, if the government would have been in the quantitative easing position, they could have absorbed a lot of this stuff, just like they did with TARP funds and just like they did in 2009, 2008 to help try to stabilize things. So that's why we saw a big, what I would call it, just a straight vertical line up because there were no buyers that were willing to buy at 1.9% return with unknown things going on.
Yeah, like why would you want to tie your money up for 10 years to get a 1.7% rate?
Yeah, and if you look less than 2 months later, you would have lost a lot of money, right?
Boom. Yeah. 2 months.
Or
Look at that. Went from 1.7, sorry, yeah, 7 to 3.12. And then by the time we hit October, 4.2.
pretty
So more
wild.
than double from March through October.
So now let's go, if you don't mind, let's go to 1 month, if you don't mind.
I don't
It's
mind
always
at all,
just
Jim.
good to get different perspective on these different trends, right? You can look at data a lot of different ways, but I always like these trends because it allows you to go to a higher level and a lower level, or in the trenches level, really quickly and understand things. So we've seen at the highs, Jason, was in the beginning of 2024. Is that April?
We can do year
Oh,
to
sorry,
date
what
if
is
you
that
want.
date?
So here's
Can
year
we
to
go back?
date.
That's fine. Yeah,
Um,
this is fine. Whatever. So, anyways, we can see that since the later part of April, beginning of May, we've seen a major decrease in interest rates.
Yep.
One of the main reasons is because Jerome Powell, the Fed, announced that they're going to talk about decreasing or loosening quantitative tightening. Sounds reverse, right? Like that's 2 minutes confusion. So they've talked about laying off the gas of selling a lot of bonds, which is a very good sign for interest rates to go lower, because that investor is going to require less money when there's less supply available. And bonds are always a flight to quality, right? If there's unknowns in the world, people go secure bonds because they're backed by an actual physical house. So and the dollar is still arguably as good as gold, right? It's one of the largest secure, if not the most secure currency in the world. So with the fact that the government's no longer going to put extra pressure on supply, and they may be easing off that approach, they could actually even turn that around and start buying mortgages back. Because if you think about it, if they were buying them at 1%, why wouldn't they buy them at 6%? Right? The government's not here to make money, obviously, but it would be a great thing for all of us to have more ability to get lower interest rates by increasing their purchasing of these debts, or allowing for quantitative loosening again, quantitative easing again.
Yeah. And the only loosening we're seeing right now is that the Treasury is not going to be buying as much mortgage-backed securities as they previously were over the past several months, right?
The opposite. They're not going to be selling off as much.
Oh, I mean, yeah, right.
Yeah. They're not going to be selling as much off. So that's a good indication. So investors are like, oh my gosh, we better bid. We better start bidding on these bonds. When investors bid on bonds, the interest premium goes down. The par rate goes lower. Because now there's two people maybe for one bond. That means who's going to take less of a return to buy that bond? It's the opposite effect. So again, when I have a big surplus of bonds, investors are the ones in charge. When there's more investors than bonds, the bond will go lower because someone will take 2 cents less of a return to secure that.
So because of this, we're seeing rates decreasing over the past couple, or
6,
actually
7 days. Yeah,
weeks
6,
now.
7 days
Yeah.
because of, and also financial markets are loving this, right? So they've been doing really well. We've had some good earnings reports come out. And then also on top of this, the jobs numbers came out lighter than
Yep.
expected, which is a good indicator for lower interest rates. Remember, mortgage people want uncertainty. We want lower interest rates. We're betting against good economic data, which sounds messed up, but that's kind of the way I have to live my life.
No, it's true, because like when there's like a bad report that shows that the economy is slowing down, more people are losing their jobs, that's when rates decrease, which is kind of like a kind of backwards, but it's basically how it works. So the Fed wants to see that, less people are working, they're earning less, and when that happens, inflation should wind down. In contrast, if a lot of people were getting jobs, their earnings were increasing. When people get more money, what do? They spend their money. That increases in inflation, was exactly what the Fed does not want to see. So as of today, which is on May 7th, the average 30-year fix for people with great credit, these are not our rates. That's at 7.19%, the lowest rates we've had since April 5th, or actually April 9th-ish this year, which was much different compared to last week. We had a 5-month high, the highest rate since approximately November last year. So quite the volatile market. But the reason why we're seeing this decrease over the past week or so is due to the Fed announcing that they're going to be doing some easing. And also on top of that, we're seeing the labor market kind of showing some early signs of some cracks as well.
And remember, little fun fact, APR, what does that stand for?
Annual percentage yield.
No, the average person's rate. We give better rates than the APR. No. So no, yeah, APR is annual percentage rate, and that's really the true cost of borrowing. And that assumes closing costs all put into a bucket to tell you what the actual cost of borrowing money is. In the car business, the reason why this was all started, some people were paying upwards of 40 or 50% APR to buy a car. So you'd be paying 2 to 3 times the sticker price to finance a car and not realize it. So a lot of things have,
crazy.
A lot of bad actors out there, but now we have APR. That's really a great way of completely being transparent about the rate you're getting.
All right, let's get to some questions here. Crime Stoppers question: do you ever get your monthly or annual MIP back when you sell? Jimbo.
You can get it back if you refinance, and that's going to be what's called the upfront mortgage insurance premium, UFMIP. It is prorated over a 3-year period of time. So if you had your loan for more than a 3-year period of time, that's a coupon book, so to speak. You would get a prorated amount back if you refinance. If you sell the property, there's a potential that you get some of that back on your principal reduction, but you do not get any of the monthly amounts you've paid. The monthly amounts are what you paid every month to enjoy ownership.
Thank you, sir. House Hacker, been a long time subscriber of my channel. Imagine if rates drop to 6%. Yeah, I could just, if rates were to drop below 6%, I know a lot of people are just like waiting for rates to decrease. And so when rates were to, if they were to fall below 6%, we could see an increase in supply, but in my opinion, we'll see a bigger increase in home buying demand, which will cause home prices to rise further. Any thoughts on that, Jimmy?
Yeah, I think that there'll be more demand. And I think that means I don't think they can build enough homes before rates go below 6% to make that difference be less impactful. So I believe we're going to have higher pressure on values, more demand for housing. And unfortunately, it means it's most likely going to be harder to buy a house if rates go lower, because your difference in buying power will have gone up because rates are lower, but so have everyone else's.
Yeah, absolutely. So Real Estate Mindset, Travis Spencer, thank you for joining us, Travis, by the way. Let us know about your home search. He's looking for a house to buy in the Houston market. And the Houston market is softening, to say the least. Also in Austin, Texas, and San Antonio, Texas as well. They actually have more houses for sale compared to 5 years ago. And I actually just made a video about that. I'll post that video tomorrow morning, of course, at 6:30 a.m. Thank you for joining. Hey guys, thank you for joining us. Appreciate you. Anyone else have any questions? We're coming up at about 4:30. I want to make sure we answer everyone's questions here. So if anyone does have any question, then please post it. Any final thoughts, Jim, you want to share in today's video?
Just whenever you're looking to do anything real estate related, especially around financing, people should offer you what's called a total cost analysis to understand the total cost of acquiring and sustaining home ownership. That's something that should be offered every time. That should also be done by looking at different options. If a bank only offers one option to you, probably not the right bank to be working with. You should get 2 options always, a lower cost and a higher cost option, to see what the break even is on getting a lower rate or having a higher rate with less costs. When you do that, you can look at the time horizon for how long you want to have the loan for to determine what the best solution for you is. So if you do that, you have all your ducks in a row. You can make a good educated decision, be empowered, and work with your lender to make sure that they have the best custom plan for you. And that's the most important part of our job, I think, is making sure that we listen, we understand your goals and objectives, and we help get those tools that you need to get there. So.
All right. And then St. Louis, the problem with the housing market is that the large home building companies have already filled up all the open land near major cities. Now they're building it in the suburbs where no one is actually. Yeah. So in general, like the markets in which there is, no land to build on. This is like Anaheim, California, for example. They're seeing the biggest increases of home prices because there's no builders, building houses. Whereas other areas, like in parts of Texas, for example, they're seeing a huge amount of houses for sale that are brand new home construction, which impacts the existing or the resale market there. So yeah, kind of well said there. There's a lot of building going on in areas in which they're not around or in big cities. Let's see. And this is why, yeah, go ahead.
No, go ahead, sir.
This is why existing home prices stay strong and movement is low, where new builds are only being sold because of the builder kickbacks. Yeah, that's one thing that when you're looking at sales of brand new houses, they normally don't share the incentives they gave to the home buyers. So it's kind of hard to compare apples to apples in the resale market. What do you want to say, Jim?
I just want to have another topic idea for next topic and next show if people want it.
Okay, let's hear what your suggestion is.
This
was my suggestion for this week.
Yeah, how credit plays a role in pricing, and credit, how utilizing your credit correctly can really leave an impact in a positive way to get better interest rates. When you're buying a home, you need to realize the key components of getting the best interest rates available. And I've seen 1 score point difference in a credit score from like a 720 to a 719 FICO middle score, or a 680 to a 679 score, be a difference of sometimes up to $1,000 a month in payment. What? So I'd like us to it's crazy. So I'd like us to maybe talk next time about credit and understanding utilization of how to be prepared to buy a home with tools that we can share with you guys next time if you want. But again, up to the audience, obviously, just thinking of things that matter and that we can focus in that are ways to be constructive while we're waiting maybe to buy that home.
Yeah, it's a good point. I often share in the channel like stats, data, but it'd be great to incorporate, real life topics to talk about to help people when they're trying to figure out if they should buy or sell a house and what that looks like, especially regarding credit. So yeah, if you guys want to see a video on that, leave us a comment below. Dawn has a question. What 3 important questions do I ask to determine if the lender person is right for me? So how do you select a lender? And obviously, Jim Black and I are licensed loan officers. So I'll let you tackle that question, Jim.
Okay, thanks, Don. So number 1, I would say they have to have a complete bandwidth to be able to offer products and services across an array of different solutions. If they're only offering one solution, they're probably not the right lender for you. So make sure that they are either able to be a banker or broker to have the ability to work with multiples of lenders. Second thing I would say is make sure that they have a reputation.
Can you talk a little bit more about that? Because I think some people may not know that. Sure. Going with one lender could be totally different compared to a broker, for example.
Sure. Bank of ABC on the corner of your street is a bank, and they only have certain conforming non-customized solutions. Those banks that can't offer more than one choice in the same scenario aren't going to most likely be the best solution for you, because they are not working with multiple sources that are competing to give you better rates.
Yeah, so I believe they're in-house lending. They have one option for you, basically one source.
Correct.
Yeah.
Yep.
Thank you.
Yep. The second category is around reputation and reviews of who you're working with. You have to learn firsthand who you're working with and what experience clients have had or realtors have had with them in their transactions. So look at their reviews, check them out, see if they have a good social media presence, look at their website. Are they real people? Third thing I would say is in their experience. Have they bought a home themselves before? How many transactions have they been working with? Are they new in this job? Do they have a team around them that can support them? Those are all things that I would say are the first steps to really think about who to work with and why. And again, everyone has different goals. Each market is different, but just find the people that you feel like you are a good fit with, and vice versa, and that are available for you. So that's all I would say.
Yeah, I think it's good. One thing I would add to that is if you can find someone ideally that you know, like, and trust, I mean, that's ideal because, you're looking to buy a house. This is, for most people, it's going to be the biggest decision of their entire lives at that point in time. And so you want to make sure you're surrounded by a good team, and that is a good real estate agent and a lender as well. Because I will say that, I have my CPA license. It's inactive because I haven't worked as a CPA in over 10 years. But getting my CPA license was extremely challenging. It took me, I think, nearly 2 years to pass the 4 tests that were extremely challenging. Each test was around a 40% pass rate. In contrast, when studying for my real estate salesperson exam in California here, I studied for about a month and passed it easily. It was a less than an hour exam, whereas the CPA exams were like 4 or 5 hours long each. So I'm not tooting my own horn. I'm just saying that because it's so easy to pass the real estate license exam, I always tell people this, that you tend to work with a wide range of people because it's the barriers into entry. Jim knows this in economics. The barriers into entry to be a real estate agent is very, very low. So therefore, there's a wide range of people that you work with. So if you can find someone you know, like, and trust, has an experience, has a social media presence, I absolutely agree with you regarding that, Jim. Anyone else has any questions? Otherwise, we'll kind of wrap this video up. Any last minute questions?
We can go drink off the beer. We can have a half beer each with that.
There you go. We'll have a drink on Steve, even though we don't live in the same city, but maybe we'll have a virtual beer.
There you go. Awesome. Thank you again for having me on the show. Thanks for all the great comments and people. I'm really honored to be on the show and appreciate you guys.
Yeah, appreciate you guys too. And Matt K says, yeah, as a CPA, it's funny because I never know what people do or where they live in general on the channel. So it's always cool to see this. As a CPA, you have very predictable and stable and mostly well-paying job. Yeah, that's definitely true. One thing that's not going to go away is paying taxes, right? Last but not least, he has this question. I live in SoCal and can't understand who is buying homes out here to keep prices not only inflates, but still going. Yeah, I would say that in SoCal in general, you don't have a lot of brand new houses that are being built. And therefore, because of that, there's this imbalance between supply and demand. I'm not a CPA by, okay, corporate accountant, same difference. Awesome. Crystal, thank you. Appreciate you. Everyone watching, yeah, thank you, Steve. We'll take that drink ticket and have one.
Maybe a Sparks, Jay. We'll get a Sparks together.
Oh my gosh, Sparks! I think they outlawed that. Oh man! All right. Hope you guys have an awesome day, everyone. Please like and subscribe, and hope you guys have an awesome day. We'll see you in the next video.